something which I'm sure you're very well acquainted with this. This is the concept of a triple bottom line for company. And पूजा, आज का जो टॉपिक होगा वो होगा ट्रिपल बॉटम लाइन. इसको
Okay, sir.
so triple bottom line, the background is that yesterday's lecture, Sarmishta, if you've had a chance to have a look at the recording of yesterday's lecture, basically that was about the corporate objective. What are the different objectives corporates have? And I was developing on that theme, very broadly. Right. Now, today we'll be looking at this concept of a triple bottom line that will wind up that particular section on corporate objective, and then we'll move on to techniques of capital budgeting. So, triple bottom line, all of us are aware that there is a concern for the planet as a whole today. Emissions from industries, the way we live, all of these things are depleting the ozone layer. And as a result of that, we are seeing global warming, and there is a problem. Now, this is something which is now a matter of concern for corporates also. So the concept of triple bottom line is that not only should company look at profit.
So you're not audible.
Okay, just check. Is it better now?
Yes, sir.
No. It's better? Okay. So let me just share the screen again and continue. So basically, that it is not enough for a company to focus simply on profit. Remember yesterday, we were talking about wealth maximization and long-term plans and things like that. But today, the point here is that as concern for our environment has become more, let's say, prominent, it's not okay for companies to simply focus on profit. They also have to focus on two other things: people and planet. So it's come to be known as the 3 Ps or the triple bottom line. So the true economic value of a company is known only after considering its environmental impact. So company, let's say, is using a lot of fossil fuels, like for example, coal, oil, is emitting pollutants into the atmosphere, is generally not at all the needs of the environment.
Sir, you're not clearly audible.
I'm not. Give me a minute, please. पूरा एक मैनेजर प्रोवाइडर चेंज करके फिर से देखा.
Okay, sir.
Pooja, can you hear me?
Yes, sir.
Properly? Is there buffering or is it okay?
So for now, this is okay.
This is okay? Okay.
Sharmishta, yes, sir.
Yes,
okay.
sir, I can hear you.
Yeah, okay, fine. Then I'll just continue. So basically, the point I was making is that companies have to be concerned about people and planet apart from being concerned about profit. It's not enough to be just worried about the bottom line. See, the bottom line is normally the line which shows the net profit in a profit and loss statement. Profit after taxes, that's considered to be the bottom line. Every activity that the company has is ultimately, let's say, geared towards getting a healthy bottom line figure, more profits. But today what happens is that we have to look at these other two aspects as well, people and planet. So the true economic value of a company is known only after considering its impact. Now, the general goal of a sustainable business strategy is to look at environment, which means planet, society, people, while also benefiting shareholders. That is the profit part. So business leaders are increasingly realizing the power of sustainable business strategies, not only in addressing the world's most pressing challenges, but driving their firm's success. And in many cases, what is happening is that customers or potential customers try to first determine whether a company is actually sensitive to this whole concept of environment. When they find that companies are not sensitive, the result is quite often that they may not give it the business that it is trying to get. So if the business itself is to survive, if the business itself is to be sustainable, then it means that it has to look after the environment. This is the basic point. So the first P is profit, and strategic planning initiatives, key business decisions, everything, all these things are generally made for the purpose of generating more profit. Now, in the past, the goal ended here. Companies profit बना रही है, वही काफी है, और कुछ नहीं चाहिए. But now what is happening is that you have to look after the environment also. You look after your people also. So that is your second P. You come to your second P, the people. Yesterday, Pooja, you remember we were discussing stakeholders. Sharmishta, if you've seen the recording, you would have seen that we were speaking about stakeholders of a company, the customers, the employees, the suppliers, creditors, community members. All these people have a stake in the well-being of the company. This was our basic point. So this is what people means. So in a very, very, let's say, in the old-fashioned way, the company was only concerned about one class of stakeholder, basically the owners of the company, the shareholders. So you make lots of profit, make sure that the owners of the shares, they get lots of dividend, and that's it. There's no need for doing anything more. But now what happens is you have to look after not just the shareholders alone, but you also look after your customers who will be sensitive to environment, to your employees who are part of the general environment, and community and society as a whole. And the moment you go into community and society, you begin to think of factors which are beyond the world of the company. You know, the immediate internal world of the company where they're only looking at their business, you go beyond that. And you begin to look at the community as a whole. That means that if you are doing things which damage the environment, you are then doing things which actually are hurtful for the community as a whole. So now you have to focus on all those things which promote not just a profitable company, but a cleaner, better environment. Now, this will include a lot of transparency. You know, your hiring practice has to be fair. You encourage volunteerism in the workplace. And they can also look externally to effect change on a large scale. How do they do this? They partner with non-profit organizations who are working in the field of a cleaner environment, in the green space. that whole space is known as the green space. So you work with such people and you make sure that your company is playing a role in the, let's say, in let's say having a greener environment. That's the basic idea there. Then when you come to the third part, the planet, one of the things that you can do is you try to reduce pollution. See, in Delhi, the Yamuna belt, there used to be a time when there were any number of industries who were basically pumping in untreated waste into the river. And the whole of Yamuna used to look like a sewer, the whole thing. Then gradually, people who were sensitive to the environment, activists, they began to go for these public interest litigations, take them to court. And gradually, a consensus built up and legal opinion was also came in favor of this. You cannot have this unchecked pollution going on, and factories cannot simply dump their waste into the Yamuna without treating it first. Now, when inspections of these plants started, when people began to become, more strict in implementing the rules, a large number of these units actually closed down. So in that way, at least to some extent, some of these polluting industries were put an end to. Now, that is one part. Okay, now look at another part. The big companies which really have the money, which can do something really good if they want to, what are they doing? 100 companies in the energy sector are responsible for roughly 71% of all industrial emissions. So think of this. 71% of the emissions, and these are basically pollutants which are getting into the air or the water, the soil, all three are getting corrupted. And they are getting poisoned by these chemicals which are being released into them. 100 companies accounting for 71% of this sort of pollution. So one thing we need to remember is that though these companies actually have to contribute much more to cleaning up their act, there is something which each and every business can do. It's not as if we just wait for the bigger companies to get their act together and do something. Everybody can actually do this. And they have to make adjustments to reduce what is known as their carbon footprint. So let's just discuss this carbon footprint for a while. So what is carbon footprint? So when we burn fuel, it burns greenhouse gases such as carbon dioxide, methane, nitrous oxide, and fluorinated gases. So we don't have to get into the chemical composition of each gas. All that we need to understand is that these are all categorized as CO2, carbon dioxide. So carbon footprint refers to the total amount of greenhouse gases released into the Earth's atmosphere as a result of the activities of a particular individual, organization, or community. So the moment you release these gases into the atmosphere, you are then creating a position where the environment is actually getting damaged because you are putting in much more carbon dioxide there than is required. Now, how do you reduce emissions? What can a corporate do? You can phase out coal or any fossil fuel, anything which is there in the ground, which we consider to be invaluable. First of all, you stop using these things as fuel. These basic two culprits here will be coal and oil. But then even nuclear today is a problem. Then you treat effluents before releasing them into the air or water. Treat them, that will help. Invest in clean energy. Like you find this movement where a number of companies, they try to reduce their consumption of electricity from traditional sources by going in for solar, for solar power. So that helps in one way. And they actually make small plants they generate solar power, and the excess solar energy is then diverted into the electrical grid. So it also contributes to generation. That is there. They're protecting forests. So industrial expansion should not be by chopping down forests. That's one. As individuals, what can we do? So reduce food and loss and waste. Where possible, we can shift to electric vehicles. These are some of the things. Apart from that, there is one more thing that can be done is, how do we pull out carbon from nature itself? We are saying that there is excess carbon in the environment. How do we pull it out? So one of the things that can be done here is that we plant more trees, because what basically it does is that the trunks, the limbs, the roots, all of these parts of the tree, they basically absorb carbon. So that is something which is one thing which we can do. And then we deploy emerging technologies such as direct air capture, which takes carbon out of the air and stores it in geological formations underground. So basically the carbon footprint is this. Now, given this background, how can we go for decarbonization? And what is decarbonization? This is basically the reduction or elimination of carbon dioxide emissions from a process such as manufacturing or the production of energy. So essentially, what decarbonization is the process of reducing emissions. That is the basic idea. Now, at least we've come to a stage in India where all our big companies today have targets for decarbonization. So by 2050, this is a target for a number of companies. What they are trying to do is they are trying to give, like the amount of carbon that they actually emit into the atmosphere. They're trying to take that back from the atmosphere and become carbon neutral. And who are these companies? You have Vedanta. See, Vedanta, Aditya Birla, these are all into mining. The JSW group. So in some cases, it is bauxite, aluminium. In other cases, it is iron ore, Adani Transmission, obviously generation of electricity. Mahindra and Mahindra, their main work would, of course, relate to automobiles. So all industries, cement, see Dalmia Cement, these are all companies which are aware of the fact that we have to decarbonize, and it is part of their corporate objective. Point I'm trying to make is that they are looking at the triple bottom line as a whole, not just at profit. And then you have Reliance, which is trying to reach this net zero level, where the amount of carbon which is emitted by Reliance is made up for by the amount of carbon that it takes away from the atmosphere by 2035. So these are some, at least the sensitiveness to what the environment is bringing in these changes, where decarbonization itself is becoming part of the corporate objective. This is one point. How does this help? Now, how does this whole, you make this extra effort, you make investments to ensure that you basically are carbon neutral. How exactly does this get back to you? Does this pay you in any way? So you have an improved brand reputation because customers, who are conscious of the fact that you are contributing to the environment, they would basically be give your brand much more value. And see, research in the US at least indicates that 64% of their consumers consider the ethical performance of a company when purchasing products. Now, that sort of awareness in India, I think, hasn't come, but I'm sure we'll be getting there as we become more and more conscious of these things, and as general sensitiveness to the environment grows, it's bound to come here also. Then it also helps to attract talent and retain talent. So good people go to companies and like to work in companies who they feel are green or at least trying to do something, rather than working in a company which is generally messing up the environment. So this is one part. So having a strategy designed to improve employee outcomes as well as the wider society can be a great way to attract and retain talent, particularly in a competitive market. So there is, let's say, a limited amount of talent in the market. Lots of companies are there competing for it. So when you have companies which are really seen to be doing something for the environment, many of the better people are attracted to those companies. The other thing is that every government has certain rules regarding environment, which all companies have to comply with. Then once you make the environment itself or decarbonization itself an objective, then it will minimize the risk of non-compliance. You will not do things which will ultimately help to, let's say, you will not, let's say, do release effluents into the air and water. You will try not to pollute the environment. And the moment you do that, you will fall in line with the laws. Okay, then improved investment opportunities. So measuring output.
Sir, what is compliance?
Compliance means to follow a rule.
Okay,
compliance simply follow a rule. So if there is a rule according to which a company is required to treat, let's say, all the emissions which are going into the air before, like, let's say it burns fossil fuel, that is creating gases. Now, if you are able to treat that before you actually release it, and if the rule says that you have to do it in this way, put up a plant which will clean it up, and you have that plant, and you are complying with the rule, then you are considered to be compliant. You are following the rules. Let's say, for example, Pooja, all of us are compliant with traffic rules. We drive on the left side of the road. We wear helmets. We use seat belts, like that. So, see, even in cars, you have emission norms. Bharat 4, Bharat 3. These are all standards which are maintained to ensure that cars are less polluting than they used to be. So a company which is following these rules is basically considered to be compliant. Now, the other aspect is improved investment opportunities. How does this happen? So measuring output in the three key areas of the planet, people, profits, means that organizations are transparent and accountable, which can help to improve investment opportunities and make a cleaner, more impactful business case for prospective investors or business partners. That means if your image is good, the chances are you will attract more investment. So because see, every big investor, they are also concerned about their own reputation. More than your reputation, they are concerned about their own reputation. So when they invest money with you, they are actually, people know that so-and-so has invested money in this particular company. And if that company is seen to be a good company, a green company, it helps their own reputation also. So in that way, companies which are compliant will actually end up with better investors. So, and ultimately, the best part is that this drives prosperity for all. You are not trying to take and just not give back anything. The moment you begin to think of planet and people apart from profits, then there is a thought for others also. It focuses your attention outward, away from your company itself. So this basically is, goal ultimately is that if we have a society which is prosperous, an environment that is clean, then ultimately it is good for business. See, there is no point, in being someone who is, let's say, very good at making money, but at the cost of others. Because if other people keep losing out, then a day will come, you'll be left with no customers. There'll be no one left to sell your goods to. So there's no point in doing that. So this basically was our presentation on the triple bottom line. And now we will move to the next part of our just a minute. Just a minute. Just a minute. Okay. So we come to the next part of our presentation. In fact, this is the main part for today. What we were doing, the
Sir,
triple bottom line of something. Yes.
If I may, I have a question regarding this carbon
Of
footprint
course.
and environment.
Yes.
Is it like all kind of companies would follow such regulations and rules for carbon footprint, or is it particular companies, for example, which are related to development sectors?
See, the
Both
point.
for environment.
The thing here is that ultimately going for a triple bottom line is not mandatory. See, when we talk about compliance, no government in the world says that you have to do this. Compliance rules are basically only made with respect to, very outright pollution for air and water and soil and things like that. But otherwise, going for decarbonization, going for these things, this is mostly a voluntary activity. Now, different companies, for example, a company which is working, let's say, in the service sector, which is not actually, right there at the, what shall I say, at the battlefront where it's cutting down forests or actually, using mining and basically, damaging the earth or something. It's not doing something like that. It will be a much more, let's say, it can only do it on a much more small scale. For example, think in terms of going for a solar power thing. Like instead of taking electricity from the in that way, you reduce your the carbon footprint. The other thing which all companies can do is look after their people better. That has nothing to do with the more let's say damaging parts of this whole story, which are with respect to the environment. As far as the people are concerned, making sure that you're transparent, you're accountable, you're looking after your people, your hiring practices are fair, your welfare schemes are in order, that is also something which contributes to the community. So that is something which all companies can do and should do. The other part, decarbonization, that is something which some companies, because of the sort of work that they do, will actually be able to contribute much, much more. And other companies which are not, let's say, that polluting as such, they can only do it to a limited extent. All service industries, for example, probably their carbon footprint is coming mostly from two factors: the way they dispose of their waste and the power that they use, source of power that they use. So I know there's a friend of mine here in near Bombay. What he does is that he is into, putting in a solar power system for companies which are based in one building. So what he does is he puts in the solar panels, he gets the whole company onto solar. And they actually manage to generate more electricity than they need, and that goes into a grid. So for service companies, I would say that triple bottom line would mean something like this. And as far as people are concerned, there is no restriction on any company, or there is no limitation as such on not doing good for people, because people are very much part of the environment. Does that answer your question, Sarmishta?
Yes, sir, sure.
That's it. So coming to this other topic, this is a more typically finance topic, capital budgeting. How do we use the capital that we have? And what are the techniques that we have to actually look at this? So I'll just try to take you through a crash course in this, because this would, done properly, it would take many more lectures, than just this 2-hour lecture. But let me just try. I promise to try my best here to give you at least something. So let's just look at this very simple balance sheet here. The part which I'm interested in is this, okay? Equity capital, long-term borrowings. Now, when we say capital in a company, it's not just the equity capital. We are looking at all the money that the company has at its disposal. And all the money that it has at its disposal includes the money that it gets by way of borrowings. So in this example, the shareholders have contributed 500. You can take it as 500 crores, let's say. And the long-term borrowings are 1,000 crores. So this company basically has stable funds of 1,500 crores. This is the capital of the company. Now, what does it do with this capital? It applies that to these different uses. It may use it for land and buildings. It may use it for machinery, for office equipment, or for investments in other companies. And then, of course, it needs money for its day-to-day operations. And then for that, it has current assets. So we won't get into this part. We'll come back to it towards the end of our, this whole little module, when we speak about, let's say, the working capital of a company and things like that. But right now, just one thing I want you to look at is this part here. This is the capital that the company actually has. Now, Now, what is capital budgeting in that case? Just a minute. Just let me. Just a minute. Okay. So the capital that we spoke about, there is you'll find, as you noticed in the balance sheet that I showed you, that there is a certain portion of equity and then there is an amount of debt. Now, the proportion between the debt and the equity, that is known as the capital structure. Okay. So what is the structure of the capital? You can say that it's 50-50. 50% is equity, 50% is debt. Debt is basically the borrowed funds. Now, these are the only two ways of obtaining capital for a company. One simple thing here. Who decides how much we need? Basically, when the company starts, at that point of time, it just has the shareholders' capital. That means it just has equity. And then as it grows, it begins to borrow. So when it borrows money, let's say it borrows money from a bank, that borrowing is based on, they have those funds for a certain period of time. So they're expected to earn sufficient revenue to repay that over that period of time. So there is a certain amount of pressure on the company to ensure that they manage to pay off that loan. If they don't do it, the bank initiates legal action. It can get into trouble. Now, both equity and debt have a cost. So a shareholder does not have, let's say, a right to get dividend every year from a company. The company doesn't have to give dividends. But that doesn't mean that equity capital is free. Because if they don't give dividends, then over a period of time, their shareholders are going to begin selling their shares. As they sell more and more shares in the market, the value, the price of their shares are going to go down. And that is going to result in basically a loss of value for the company. पूजा आप समझ रहे हैं इस चीज को ना? कैपिटल स्ट्रक्चर जो है वो क्या है? इक्विटी और कैपिटल और डेट किस प्रोपोर्शन में आप रखते हैं? इक्विटी फ्री नहीं है, उसमें आपको डिविडेंड देने की जरूरत है. आप देर सवेर कर सकते हैं उसमें, यू कैन डिले, बट अल्टीमेटली यू हैव टू पे. और इन द केस ऑफ डेट, उसका कॉस्ट क्या है? उसका वही कॉस्ट है जो इंटरेस्ट रेट्स आपको चार्ज किया जाता है. दैट इज द कॉस्ट ऑफ डेट. सो what is the cost of 200 crores you raise through equity shares? अगर डेट का कॉस्ट 12% है और डेट में there is less risk. When a banker gives a loan to a company, the banker okay, Sarmishta, you're back now. So when a banker gives a loan to a company, the banker, as compared to the shareholder, has less risk, because in case for any reason the company defaults, is not paying back the loan, the banker can take legal action and ensure that its loan is repaid. But that does not happen in the case of a equity shareholder. In case the company doesn't function well, if in case the company has to be liquidated, its assets are sold, even then the equity shareholder cannot expect to get back all his money. So there is definitely a higher risk that the equity shareholder takes. What is the significance of this? If the equity shareholder takes a higher risk, he expects a higher return. So if the bank giving a loan is getting 12%, you can bet that the equity shareholder will be expecting to get much more than 12%, because he has taken a much higher risk. So this is the point I'm making here. And a reasonable return for an equity shareholder should be close to 20%. I'll also try to show you what exactly equity shareholders in India get later on in this presentation. Now, right now, let's go to our next part here. So capital is the total funds in the hands of the company, the point which you made earlier. Capital structure is the proportion of equity and debt, what proportion it is in. Now, let's start with the simplest form of capital structure. All the funds are brought by the promoter. Whoever started the company, he contributes all the funds. So total funds by the promoter. Structure, what is the structure? 100% equity. Now, he wants to expand his company. Now, the moment this promoter wants to expand the company, he goes to certain rich individuals and he asks them to become shareholders in his venture. So when he does this, it becomes something like this. He takes from this 100%, he takes a slice and he sells it to these people. So now what is the structure? It's still 100% equity. But now there is one change which has come. There are the promoters who have most of the shares, and then there are these other shareholders who also have shares. But so far in this company, in this form of capital structure, you do not have any borrowing. Sir Mishra, are you getting this?
Yes, sir.
Fine. Then company begins to take loans, let's say. Then it's going to look something like this. The original promoters' equity, the promoters, they have, let's say, 51%. The other shareholders have 19%. And now 31% of the total money in the hands of the company is now coming from loans. So now what is the proportion of equity? It's this 51 plus 19, which is actually not 69, it should be 70%. This is the proportion of equity now. And the rest, the 30%, is in the hands of the promoters. So that's that part. Now, owner's equity plus shareholders' equity, in this case, is also known as shareholders' capital. So this is one basic point that we're making. Let's have a look at this in the case of different companies. So here we have the balance sheet of NTPC, the National Thermal Power Corporation of India. So this is a company which is very capital intensive. It requires a lot of capital to run a thermal power company. Now, if you look at their equity share capital, I've given you 5 years here, from March 2017 to March 21. And what do we see here? We find that in March 17, it had 8,245 crores of share capital. This has increased to 9,696.67 thousand crores in March 21. Now, over the years, over the last 50 years that NTPC has actually been in existence, it has cumulative profits of 1,09,288.82 crores. So every year, the profit which NTPC made, that profit is considered to be an internal source of capital in the balance sheet that is put under the head reserves and surplus. So this also becomes part of that shareholders' capital. So the total shareholder funds for NTPC in March 21 is 1,18,985.49 crores. See, in March 17, it was 96,231. Why was this the case? One, because its profits at that time, the accumulated profits, were 87,985 crores. This every year kept increasing till it reached this particular level. And now the total shareholders' funds are 1,18,985.49. This is their actual balance sheet for this year. If you look at the borrowings, we find that the long-term borrowings are a little more than this. It's 1,51,229 crores. This again has increased from the 97,339 crores that it used to be in March 2017. So if we look at the capital structure of this company, and if we just do a simple calculation on a calculator, you can calculate the actual proportion. So what are the total long-term funds that this company has? It's this 1,51,229 plus 1,18,985. This gives you 270. So if 270 lakhs is the total capital that it has. Out of that 270 lakhs, what is the proportion of the equity? It is 43.7%. So let's say 44% is equity, 56% is debt. So remember we said capital structure is all about the proportion of equity and debt. So what is the proportion of equity for NTPC? It is 44%. What is the proportion of debt? It is 56%. So this is a broad idea of capital structure. You look at Tata Motors, another example here. Here again, you can see equity share capital is just 765 crores. So remember, NTPC, that's a giant. Motors will be smaller, obviously. But even theirs is 765 crores in 21. Their reserves and surplus are 18,290 crores. This is the total amount of profit that the company has earned over the years. And its total shareholder funds are 19,055 crores. The long-term borrowings are 16,326 crores. So if you look at this particular company, you have what will be the proportion in this case. If you add these two, so you are getting roughly 35,000 crores is the total funds that it has. So if we look at the equity portion, roughly 54% is equity and 46% is debt. So I think from these two examples, you should be getting an idea about what capital structure is all about. Why is capital structure important? Because the cost of capital, the cost of the total funds that you have depends on how much is in equity and how much is in debt. Because generally equity will be costlier. So this part, this 19,000, this part here is going to be at the cost of this, it will be higher than the cost of this 16,000. And why is cost of capital important? Because when you budget, you have to earn more from any project that you do than your cost of capital. Otherwise, you will be in a loss. That is why I thought I'll show you this first. So, this is one simple example, but just to show you that maybe, there are other companies which operate, which have less borrowings or no borrowings. There are such companies also where 100% is equity. I give you the example of Infosys. Infosys, the equity share capital is 2,130 crores. The reserves and surplus, all the profits that Infosys has earned ever since it came into being is 69,000 crores. Its total funds are 71,531 crores and its long-term borrowings are zero. See, this is an IT company. This is a company which requires human resources. It doesn't have to go about buying machines and things like that. All it needs is some basic equipment. It needs servers, it needs computers, it needs equipment, which is nowhere near as costly as the sort of equipment Tata Motors would need for making automobiles, or which NTPC will need for generating electricity. That is capital intensive. A lot of capital is required. So the capital which NTPC or Tata brings to the table is still less than the amount of capital that is actually required. So they borrow. But Infosys doesn't have to borrow. So their capital structure is 100% equity. Look at Tata Consultancy. Tata Consultancy again. This is a consulting firm. It's all about software. Equity share capital, 370 crores. Reserves and surplus, 74,424 crores. Total funds at their disposal, 74,794,000 crores. And what is the amount they borrow? Nothing. Zero. So this is again a company which is dealing in software, which is not capital intensive. Here, the main assets are not physical. The main assets are human resources. So you don't have to borrow for that. You hire good people. And as a result, it has a long-term borrowings of zero. So their capital structure is 100% equity. It also means that their costs for, the cost of this equity is going to be a little higher than the cost of a company which has a lot of debt. We'll see that through some simple examples that we have. So let's take, now that we have an idea about what capital structure is, let's try to look at, the cost of capital part. So let's say there's this company. It has equity shares. Equity capital is 2,000 crores. On an average, they are paying 20% as dividend. So the cost of these 2,000 crores will be 20% of 2,000 or 400 crores. This is the amount they have to make this much profit, and they have to pay this to their shareholders. The loans, 1,000 crores, and at 12%. So what are they doing? 120 is the amount of interest that is charged. So now if you look at the total funds at their disposal is 3,000 crores, 2,000 from equity, 1,000 from loans, total 3,000. And the total cost, the amount that they have to pay in terms of interest or dividend, is 400 plus 120, 520 crores. Now, the total cost of funds in terms of we'll get to that. Look at company B now. Equity cost 20%. This is the reverse. Capital structure is exactly the opposite of company A. Here, what has happened is equity is less, 1,000. Loans are more, 2,000. Total funds at their disposal are the same as company A. Both have 3,000. Now, in the case of company B, you have equity. The cost is 200 crores at 20%. 20% of 1,000 is 200. Cost of loans is 240. 12% of 2,000, 240. Total cost, 440. So the cost of capital for them is basically 440 over 3,000 into 100, 16%. Cost of capital for this company, which has more equity, is 18%. So even in a very simple, straightforward calculation, you will always find that companies with more equity will have a higher cost of capital. Okay? Capital structure, 67% equity, 33% debt, and the cost of capital is 18. Here, equity is 33, debt is 67. The cost of capital is 16. This is one point. So now let's look at the implications of this. What does this mean? So this is company A, this is company B, and these are, I've just taken this a little further now. So the total in both cases, remember, is 3,000, the amount of money that they have in their hands. The profit before interest and tax for company A is 500. Let's say it's the same for both. 500 crores is the profit here. 500 crores is the profit here. Now, in this case, interest is 120 because of that debt which they have. And interest here is 240. Remember, they have more loans. So it's 240 here. And
Yes, sir.
so profit after interest will be 380 in the case of company A. Profit after interest for company B will be 240. So profit after interest obviously is going to be higher for company A because they have less loans. So tax, let's say, is 171 and 117. Why did the tax go down here? because tax is calculated after interest. So what will happen is, if you have less loans, you will pay more taxes. This is the point which I'm trying to get across. This company has less loans, so it will pay more taxes. This company has more loans, it will pay less taxes, because profit is calculated after taking into account all expenditure, and interest is an expenditure. So by that logic, this company will save on taxes. So profit after tax for this company A is 380 minus 171, 209. And for this company, it's 240 minus 117, it's 143. Now, if you look at return on capital employed, what is capital employed is what? This, 3,000. If you look at this, the return will come to 209 divided by 3,000 multiplied by 100. That's about 7%. This is rounded off, but it is about 7%. For these people, it will be 5% because they've paid more taxes. But the return on equity, see, the promoters, what did they put in? They put in 2,000 crores here. They put 1,000 crores here. This group of promoters, which had put in 2,000 crores in company A, what is the amount they have earned on their equity on this 2,000? They have earned 209 crores. In percentage terms, that means they have earned 10.45%. These promoters, because they borrowed more, paid off their borrowings, at the end of the day, they have a return on equity of 14.30%. So the advantage of borrowing is that you can actually get a higher return on equity because you use funds from banks or other borrowers. You will use less of your own funds. You put in your own funds to a certain extent, in this case, 1,000 crores. And then on the basis of this, you borrow. Using your own funds as a base on which to borrow is known as leveraging. This is what is called leveraging. So you leverage your own funds and you get another 2,000. So you have in as the same amount of money as this company A. You also end up with 3,000. You make the same amount of profit. You pay less taxes. And at the end of the day, you are able to get a profit after tax return on your equity, which is more than company A. So the capital structure that you have has an impact on the amount of money that you will earn in the long run.
Sir, it means if we borrow less money from bank, then we have to pay less interest.
Yes, that is, you will pay less interest, but you will pay more taxes.
Okay.
Consider this also, Pooja. You will pay less interest, but you will pay more taxes. Now, look, this very simplified way of showing this doesn't show you one thing. When you borrow from a bank, it is expected that you are always regular in repaying the bank. Because if you are not able to pay the bank on time, then the bank will basically start legal proceedings against you. And that is very bad for the reputation of your company. So one big thing here is that under no circumstances can you default. Default means not to repay. You cannot have a situation where you default. So going for this structure where you borrow more also increases the risk as far as a company is concerned. And if we look at companies in India, we find that all our big companies have borrowed a lot, and many of these big companies have not been able to repay, and they are in trouble because of that. So this is, so if you take one famous name, let's say you take the Adanis. So for example, the Adani structure is closer to B. is closer to this because they borrow a lot. Okay. You go for Reliance, it will be closer to A because they have higher equity, less borrowing. And in the case of Adani, it's the other way around. Both are making money. These are two different capital structures. Both are performing. But these thoughts will give you an idea about how capital structure impacts cost, how it impacts taxes, and how it impacts returns. That is what you should be looking at. So this is the same table, just showing you the return on capital employed in equity again. The only difference is that here what I have done is I have just changed these figures, but I have changed them proportionately. So this used to be 1,000 in the last slide. I have made it 2,000. The loans were 2,000 in the last slide. I have made it 4,000. So the total money at their disposal has now gone up to 6,000. Their profits have doubled. Interest has doubled. Profit after interest is 520 now. And profit after taxes is 286. Their return remains the same. Return on equity also remains at 14 as it was in the previous slide because everything is in the same proportion. But the actual amount of profit that they earn now is much more than last time. It is double. It was 143 in the last slide. It is 286 now. How are they earning more? Because they put in more. They brought in 1,000 crores of fresh capital and they borrowed another 2,000 of loans. This is the basic point here. So the returns, they remain the same, but the amount that they earn is much, much more. This is also a way of saying that this company is creating more wealth. Remember yesterday we were talking about wealth maximization. So this is one, here you see in this particular table, how wealth is maximized by earning more profits. So this is, how does this cost of capital help? It helps in evaluating an investment decision. Decision relates to whether to invest or not. And this is what capital budgeting is all about. This is what capital budgeting is about. Huh? How do I use the money that I have? And when I say, how do I use the money that I have? I also have to consider the cost of the money that I have. So an investment can be made if the expected rate of return from the project is higher than the cost of capital. This is the basic point I've been trying to, everything that I have covered so far is basically to bring you to this point. And in our example, project A has a cost of capital of 14%. The company will go ahead with this project if the rate of return expected is more than 14%. If a company has a 14% cost, it can go for a project only if the return is more than 14. Remember when we were calculating this part, Sharmishta, you have not done. We will try to cover it today. So every company has what is known as an IRR, an internal rate of return. Now that internal rate of return for a company, for this company, has to be more than 14, otherwise it will go into loss. Because it will be earning money, but it will be earning less money than it is paying to its borrowers. And in which case, it is going to be in trouble. So the methods for calculating the rate of return are NPV and IRR. We can look at that. And of course, once you know the cost, it will help you to take decisions about debt. And like I said a while ago, debt increases the financial risk of the firm. And the capital structure decision aims at maximizing the value of the firm while minimizing the overall cost. That is the main function of capital structure. And then, it becomes a yardstick for performance appraisal. So let's say a shareholder wants to evaluate the performance of the top management. So when he wants to do this, what he will basically be looking at is, he will look at these parameters. Are you earning more than the cost of capital? And the best part today is that even for an outsider, even for a small shareholder, all this data, all these figures that we are talking about, all this is available for the big companies on websites like Money Control, for example. Moneycontrol.com. Go there, type in the name of a company, go for their financial statements, get their profit and loss statement, and you will get all the details. Those little screenshots I showed you of capital structure, those are all taken from Money Control. So basically, once you look at those figures, you will be able to, sort of find out just how well that the management is performing. Are they actually earning money for you? So the return on total funds invested, capital plus debt, by the firm should be higher than the cost of capital. It's basic, simple arithmetic. If this is not the case, then the company is losing. And if it's earning much more than this, then wealth is being created. This is the basic logic here. So with that in mind, we can now move to this. For the moment, I will send this to you people when I send the presentation, but there's no need really to go into this in detail right now. This is just a way of calculating the cost of debt after paying taxes. So for example, just let me give you the bottom line here. Let's say the cost of debt is 15%. Taxes are 45%. So cost of debt is 0.15. Taxes 1.1 minus 0.45. So 0.15 into 55. This is the portion which actually you have to pay for, because as far as the taxes are concerned, that part is being calculated after interest. So the only amount, your actual cost is coming down to 8.25%. The post interest rate has been reduced by the tax rate. Since the tax rate is 45%, we are paying only 1 minus 45, 55% of the interest. That is 8.25. It's just given to you so that you understand that tax actually helps to reduce the cost, because you don't pay taxes on the interest that you earn. That is the logic. So, you can say that government is paying part of the interest because they don't bill you for that part. This we don't need to do. Just a minute. Just let me now get to the part where we can start with this now. Just keep looking at this slide, and I'll just be back with a glass of water and I'll continue. I hope you've read this. Basically, it says everything that we've just been discussing. It talks about the fact that what is capital? It's basically in the form of equity or debt. Budgeting is the process of deciding how to use these funds. So what are the questions which arise here? A person making a budget for a company, what exactly is this person looking at? So what projects should the company invest its funds in? How do we decide which of the projects is better? The company is subject to audit and is also accountable to its shareholders. So it has to be careful in taking a decision. Why am I writing this? Because if the management feels that they can take irresponsible decisions, they have to realize that when the audit comes, and if they haven't acted properly, then in that case, whatever wrong actions that they've taken, that will be brought to light by the auditors, and that is going to impact their reputation adversely. I'm talking about the ideal scenario. This is how it should be happening. The auditor has a duty to report anything that is not, let's say, above board, anything that is against the rules. So this is one point. Now, when you decide what sort of project you want, basically you're looking for a project that is in keeping with your mission and vision. You've decided to work in a particular space. You want to, work in particular things in a particular industry, focus on particular projects. So the project that you have has to be in line with that. Then the second part is that whatever project you choose, it should result in wealth creation so that the shareholder value increases. So you're looking at a project that is likely to give you the highest return, and you can decide which project is giving you the highest return on the basis of, let's say, two of these methods which I'm giving you. These are classic methods which have been there right from the beginning, I think. Any particular, calculation of whether wealth is being created or not will in one way or the other use these concepts, NPV, IRR. So we'll get to this. And remember one thing, when we discuss capital budgeting, what projects we should have, we are only looking at the financial aspect. There are many non-financial aspects in taking this decision, but that is not part of our course here. The non-financial things are not things which you would interest a finance professional. The finance professional is basically interested only in telling you about the numbers. If you do this project, what exactly are you going to get from it? So remember, it's all about the numbers here. So the first concept we look at is net present value. Now, Pooja, you will remember the concept of present value.
Yes, sir.
Sarita, are you aware of this present value?
No, sir. No, sir.
Okay. So basically, let me just try to explain this to you, in very simple terms. See, the value of a rupee today, value of 1 rupee today, is more than the value of 1 rupee that you will receive 1 year from today. Does this make sense?
Yes.
So you have 1 rupee today, it's one thing. Now, if you're going to receive this money 1 year from today, that 1 rupee in absolute terms is still the same as this 1 rupee. But that 1 rupee is less valuable to you than the 1 rupee that you have in hand today, for one simple reason, that the 1 rupee that you have in hand today can be put in a bank and you can earn interest on it. Let's say there's 10% interest, that 1 rupee will become 1 rupee and 10 paise in 1 year. But the 1 rupee that you get after 1 year will still be 1. So in very simple terms, if you get money which is later on in the year, after 1 year, 2 years, 3 years, sometime in the future, then basically you are getting less than the same amount if you were getting it today. So what you get today is the present value. What you get in the future is future value. So if you take, let's say 1 rupee, you invest it for 1 year in a bank. After 1 year, you get, let's say 1 rupee and 10 paise. That is future value of 1 rupee today. 1 rupee 10, if you receive 1 year from today, what is its present value? It is exactly the opposite. It will be 1 rupee today. So it's like taking 1.10 and dividing it by 0.110. You do that, you will get 1. So the basic point here is that money which is receivable in the future has to be brought to its value today to understand if I'm making a profit or not. So in this example, let's see, you might understand it better this way. So let's say, suppose you're an industrialist. You have an industrial unit and you want to buy a machine that costs 10 lakhs. This is your project. You're doing something, you need to buy a machine that costs 10 lakhs. So your capital budgeting is this. You have the money, you want to spend 10 lakhs. Now, before you spend these 10 lakhs, you want to find out a little about how much you will earn if you invest these 10 lakhs. So the machine has a life of 5 years. And it is estimated that you will earn 3 lakhs per year from this machine. Your earnings are going to go up by 3 lakhs per year. This is an estimate that you've made. Now, if you don't buy the machine, suppose you don't buy the machine, you still have the 10 lakhs with you, and you have another offer. Another company tells you that, look, just give us those 10 lakhs as a deposit, and we will give you an interest of 10% per annum. Now, suppose that we forget about the risk part for the moment. Whether that is risky or this is risky, let's just say that both are equally risky. Giving money to a different company, getting them to earn money and paying you 10% on that money is as risky as you buying a machine and then working that machine and earning 10% from it or more from it. Now, if I want to find out whether, these 3 lakhs that I'll get per year is more than the 10% these guys are giving me, then what I have to do is, I have to basically do a simple calculation like this. It looks terribly complicated, I'm sure, but it's pretty simple actually. So this is your investment here, 10 lakhs. After 1 year, you get 3 lakhs. But this 3 lakhs is being received after 1 year. So it's not equal to 3 lakhs today. This is the basic point which I'm trying to make. The present value of these 3 lakhs is 3 lakhs divided by 1.1. Why 1.1? This is 10% interest. 1 represents the principal. This is the interest component. So 10% is 10 divided by 100 or 0.10. So when you do any calculation trying to figure out what a future amount is equal to today, you divide it by that interest, 0.10, but you add the principal to it, 1.10. Then you will get a complete figure. So 3 lakhs divided by 1.1, what you are getting is 2,72,727. So just like we said that 1.10 receivable 1 year from today is equal to 1 rupee today. By the same logic, 3 lakhs receivable 1 year from today is equal to 2,72,727 rupees today. If you do the reverse calculation, it will look easier. Suppose I have 2,72,727 today, right now in hand. I put it in a bank and the bank gives me 10% interest. Then after 1 year, I'll end up with 3 lakhs. You get the logic here, Sharbishta? Dharmishta, can you hear me? Okay. Pooja, आपको तो समझ में आ रहा है ये?
Yes, sir.
Okay. Then in that case, year 2, money which comes in year 2, this is coming after 2 years. So instead of multiplying by 1.1, or rather dividing by 1.1, I will divide by
1.1 square.
Yes, by 1.1, which is 1.21. So when I divide 3 lakhs by 1.21, I'll get 2,47,934, which basically means that it is less than the 272 that I got here today. In the case of year 3, 3 lakhs I divide by 1.10 to the power 3. That's 1.10 multiplied by 1.10 multiplied by 1.10, which is 1.331. And when I divide 3 lakhs by 1.331, I get 2,25,394, which is again less than 247, much less than 272. And when I do the same calculation for year 4, I divide 3 lakhs by 1.10 to the power 4, which is 1.4641, giving me 2,04,904. And in year 5, I divide 3 lakhs by 1.61, which gives me 1,86,276. Now, to get the total amount of money, the present value of all these cash inflows, I add all these together and I get 11,37,236. Therefore, the NPV is 11,37,236 minus 10 lakhs, which gives me 1,37,236. So the basic logic here is that if I get a positive NPV,
Then we should go for it. For this project.
Essentially, we are getting a return which is higher than the opportunity cost, the 10%. So the internal rate of return for this project will actually be more than 10%. And that is why we are getting a positive figure. Had it been exactly 10, this would have been 0. Okay. So what this table tells you is that you will earn more than your investment because your net present value is positive. Okay, so this point, this was net present value. Now, we look at the same thing, but now done over a 10-year period. Now, in this 10-year period, once again, we are getting a total of 15 lakhs from our investment at the rate of 1.5 lakhs per year. The discounting factor is the same, 1.10. And we keep doing the same calculation. This time, we find that as we go after year 5, our calculations get more complicated. The amount of money that we get, the present value of the cash inflows that we receive keep going down. In the 10th year, this 1,50,000, its present value is only 57,831. And when we add all these, the present value of all these cash inflows, we get 9,21,685, which is less than the 10 that we had invested. So we get a negative NPV, which basically means we should not invest. That means if you are getting a return, which is spread over a very long period, the total present value is going to be less than your investment, as against the same amount of money received in a shorter period of time. So time has a lot to do with whether you should make the investment, whether investment is profitable or not. That's the basic point that we are making here. And this also means that the return from the investment is less than 10%. Because we were using this discounting factor of 10%. As we said here, discounting rate is 10%. So once we do this exercise, we begin to realize that this will be of assistance to us in deciding whether to make this investment or not. This is the basic idea behind this particular calculation. The acceptance rule is very simple. If NPV is positive, you accept. If NPV is negative, you reject. If NPV is 0, it's up to you. Up to you, this simply means that your decision will now rest on non-financial factors. As in terms of finance, you are at least not making a loss. If there are some other good reasons to take this project, let's say it's greener, it's better for the environment compared to other projects, then
Yes.
possibly you can decide to do this project. Clear, Pooja? This
Yes,
was
sir.
the method of calculating it in Excel. Sharmishta is back. Sharmishta, you missed that. Should I repeat that for you?
Yes, please, sir. I actually kind of got locked off.
Got it? Okay, fine. Just a minute. Pooja is a team player, so she won't mind, I'm sure.
Yes, sir. I will.
Okay, so we're coming to net present value. So remember, we said that basic point for you to remember is that money received in the future will have a lower value than money which you have in hand. And the money that you have in hand, that, that is basically the present value of money. Because that money you can actually spend. Money which is receivable in the future will have a lower value because you lose the chance to invest that money and earn interest. At another level, money loses value every year because of inflation also. So you can think of it in that way. Now, here we said that we are trying to take a capital budgeting decision. And this decision is basically, I want to invest 10 lakhs. And this machine that I'm going to buy, this is going to increase my earnings by 3 lakhs per year. So every year I'm going to get 3 lakhs. In 5 years, I'll get a total of 15 lakhs. Had I not made this investment, suppose I didn't make this investment, and I invested this money in another company, that company would have given me 10% return. So I would have got, let's say, 1 lakh per year from that company if I had invested it there. And they would have kept giving me that 1 lakh. And at the end of it, they would have returned my money to me also. So basically, at the end of 5 years, had I gone to the other company, I would have got 5 lakhs as interest and I've got my money back. So total, I would have got 15 lakhs there. Here, what is happening is, I buy the machine, I do my business, and I earn 15 lakhs at the end. The question we need to know is, am I making a profit or not? So even though I'm getting 15 lakhs, this 15 lakhs is based on the total of the money I will receive every year, those 3 lakhs, in the future. So the first 3 lakhs comes after 1 year. If I reduce it to its present value, what is its value today? I have to divide it by 1.10. Why 1.10? 0.1 is the decimal of my interest, 10%. 10 divided by 100 is 0.10. For making this calculation, you add 1 to it. 1 represents the principal. So 1 plus 0.1 is 1.1. If you divide 3 lakhs by 1.1, you will get 2,72,727. You get this, Sharmishta, this point? Sharmishta, can you hear me?
I think, sir, she having network issue.
Yes. Sharmishta, please look at the recording. I've tried to explain this step by step in the recording. So Hello.
Yes, sir, I'm there. Actually, a lot of network problem is happening. I can click into the repeat on the problem.
But did you get this point, this simple point here?
Yes,
3
yes,
lakh.
I got that.
So now if you reduce each year, the inflows that you receive to its present value, and you add these present values, you will get 11,37,000. So that 15 lakhs that you receive, the present value of those 15 lakhs is 11,37,000. But since this is still more than this 10 lakhs, this means that you are making a profit, and therefore it's good for you. Now, if you do the same thing, suppose we make the same investment, but this time we expect to get 1.5 lakhs each year for the next 10 years. Then in that case, what happens is that when we do this present value calculation, we end up with 9,21,685, and we had invested 10 lakhs. Therefore, it's a loss-making proposition. So in financial terms, I should not be making this investment. So the basic rule is, if NPV is positive, accept. NPV is negative, you reject. And if NPV is 0, you may accept. Why may accept? May accept means now you look at the non-financial factors. Financially, at least you won't be making a loss because it's 0. You won't make a loss. You will get back as much money in present value terms as you had invested in the beginning. But now you'll have to look at other factors. Maybe it's a green company, it's a better investment. So you could use logic of that sort to justify your investment. If you want to do this calculation in Excel, use this formula. Just type these figures in. You can keep changing these figures. The net present value will keep changing. This is a comparison of two projects with the same discount rate, same amount invested, but different cash flows. See, the cash flows are different in both cases. The period over which you will get the cash flows are also different. And you find that the NPVs are different. So if the choice for your company is to invest either in project 1 or project 2, financially, the figures say, the numbers say that you should be investing in project
1.
Yes. Okay, so that's one part. And what is the basic good thing about NPV? It considers time value. It considers all the cash inflows. And since it is the net present value, it is possible to add the NPVs of different projects. So if the project A has an NPV of 10 lakhs, project B has an NPV of 5.5 lakhs, both are positive, they can be accepted. And you also know that the cumulative benefit is 15 lakhs, 10 plus 15. So if I do these two projects, by how much will the wealth of my company increase? It will be 15 lakhs. So this is one point. What are the limitations? The basic limitation in all this is correctly estimating the cash flow. See, you're trying to look into the future and make these estimates. It's not easy. So that is the big problem that you face. Then we look at the same thing, but now from the, let's say, vantage point of rate of return. What is the rate of return of a project? So this rate of return that a project has, this is known as its internal rate of return. And this is the rate of interest discount at which the sum of the future cash inflows is exactly equal to the amount invested. It tells an investor the actual rate of return that she will get over a specified period of time, and assuming a series of cash inflows over the period. So suppose there is a bond, it's priced at rupees 100. I'm giving you a slightly different example now. The coupon of the bond or the interest rate of the bond is 15%. It's payable every year for 7 years. So when you invest in this bond, you will get a 15% return every year for 7 years. What is the return, keeping in mind that you will receive rupees 15 a year for 7 years? The present value of each rupees 15 will be less as over years 1 to 7. So if you want to calculate this, it's very difficult to do this manually. But in Excel, the formula is very simple. You take a sheet, Excel sheet, you type this simply. In year 1, you are investing 100. So since the money is going out, you say minus 100. Every year, you are getting a 15% return. So you keep writing this, year 1, 15, year 2, 15, year 3, 15, 4, 15, etc. Till in year 7, it's 115 because it's a bond, not a project. It's a bond. You're getting your money back. So at the end of the day, what will happen is you will get your IRR. And IRR in this particular case will be exactly 15%. So basically, this is a simple way of calculating the IRR. Now, if we do the same thing for, let's say a project of 10 lakhs, and I want to find out, let's take that case which we had, the one where we ended up with a loss. Remember that the second example I gave you, where I said that if we invest 10 lakhs in a project and we get 1.5 lakhs per year for the next 10 years, and we did that present value calculation manually, and we found that we are getting less than we had invested. It was 9,21,000 instead of 10 lakhs. Now, as a matter of curiosity, yes, Sharmishta? Now, as a matter of curiosity, you might want to know what was the actual rate of return of that project. So we know that we were discounting it at 10%. We were getting a negative figure. So obviously the rate of return was less than 10%. So how do we do that? We can do this in Excel. If you do this simple exercise, you write 10 and you put all these figures here. In year 10, it's 1.5. The internal rate of return is 8.144%. Now, how does this help you? How it helps you is your opportunity cost was 10%. That is the next best opportunity that you had in hand was giving you a 10% return. Remember, we said that if this same 10 lakhs is invested in a company, they will give you a 10% return. Here, what is the return that you are getting? You are getting 8.144. So if I just take these two figures, I know that I should not invest in this particular project. So whether I go the NPV way or I go the IRR way, in both cases, I will know exactly whether it's a good decision to invest in the project or not. So the moment I see this 8.144, forget about the way it was calculated. If I just look at these two figures, cost of opportunity cost, 10%. Internal rate of return, 8.144%. I should not invest. Naturally, I want to earn more than what I could have earned somewhere else. By the same token, I can use cost of capital as something to compare this to. Suppose the cost of capital itself is 9%. And I am getting a rate of return which is 8.144%. Then there you are. You have a very clear financial indicator that you should not be doing this particular project. So, these concepts now of internal rate of return, and so I've done this manually here now for you. The same thing done manually using 8.144, and you can see that it becomes 0. The present value of all these cash inflows will be exactly 10 lakhs. So 10 lakhs you started with, 10 lakhs it ended with. If this is 0, that is my IRR. That is the point. The project has an internal rate of return of 8.144%. If you want to invest, your cost of funds has to be less than 8%. This is the basic point which we are trying to make. So there it was done in Excel. Here I've done it manually for you. If you want to do this just for the sake of trying it out, you can do this on an Excel sheet. You do this, it'll be very simple. Do it manually. You will understand how the whole thing happens. If you are that interested. Otherwise, just do it in Excel. That will give you an idea. But this tells you one simple thing, that at the end of 10 years, the total of all these cash inflows is exactly 10 lakhs. And this is the amount that you had invested in the beginning. So when these two figures are equal and you get a 0 NPV, whatever rate you used to discount these cash inflows, that rate is your internal rate of return. And in this case, that rate is 8.144%. Like I said, calculating this rate manually is a very painful process. So get the rate from Excel, then try it out manually. For your understanding, it's the best that you can do. Now, this, we will stop here for internal rate of return. And these I will send to you, but because of paucity of time, I will now skip to the other methods, but have a look at these slides. These will give you comparisons, where cash flows are different, how this basically changes things. So coming to an evaluation of IRR, what exactly are the good points of the IRR system of using this internal rate of return as a method of evaluation? So it considers the time value of money. So, the timing of the cash flows are used. It discounts them to arrive at the present value. It considers all the cash flows over the life of the project. And it has the same acceptance rule as NPV. Whenever the IRR is greater than the opportunity cost or opportunity cost or cost of capital, the shareholders' wealth will be enhanced. Whenever it's lower, you should stay away from it. Limitations, big limitation is always that estimating rates of return, estimating the proper rate, the cost of capital, estimating the cash inflows, that is always a problem. And that problem is there with NPV, that problem is there with IRR. But any look into the future, any attempt to look into the future is always a dicey proposition. It's never going to be easy. So that limitation is inbuilt into any forecast. And therefore, it applies to both NPV and IRR. Where there is an inconsistency between the IRR and the NPVs, we can use the incremental approach to reconcile the difference. This approach was there in the last slide. You can look at that. In case you need any further explanations about that, we can discuss that in a subject to time being there in some other class. And I have an open offer for all of you. If at all you want to discuss these things on a weekday, just let me know on WhatsApp and we can do this. Not a problem at all.
Okay, sir.
Now, the next thing here is, using the same method, we can arrive at what is known as the profitability index. So once again, the basic method is the same. Like this. We have this case here, 10 lakh investment, different cash flows received over 5 years, 2.5 in the first year, 2.8 in the second year, 3.5 in the third year, 3 lakhs in the fourth year, 2.5 again in the fifth year. 10% is our discounting rate. And we get the present value of each of these cash flows. We end up with an NPV which is positive, which is 81,722. Now, what is the profitability index? Basically, you take the present value of all the cash inflows, the sum of the present values. You divide this by the amount which you had invested. If you get a positive figure, basically means that you are increasing wealth. You are making a good investment. So it's just a way of presenting things. See, it's not as if anything new has been done. You're still using the same present value concept. You're still using the same NPV method. The only thing is that this is how you present it. It may be easier for you to think of it like this. If I get a +1 figure, that means it's worth investing. If I get 1, then I rely on non-financial factors, because then at least I'm not losing money. And if I get less than 1, then I should not make this investment because I am actually losing money. So that's the acceptance rule here. What are the advantages of the method? It recognizes the time value principle. It is consistent with value maximization. The index can be used to compare different projects. So if I have many projects and if I can calculate the index for each, then I can simply look at these projects and then go with that project, which gives me the highest profitability index. That is the basic logic there. Any project with a positive NPV will also have a profitability index which is greater than 1. You can see that here also. Just so that you don't miss the point, I've put it here again. So that's it. Now we go to a much more simple method, payback method. Now in payback method, basically what happens here is, I am not considering time value. I'm not considering, the more, like sophisticated ways of doing it. All I'm doing is, I'm just looking at one parameter. How many years are required to recover the original cash outlay invested in the project? So if the project generates constant annual cash flows, then the payback period is calculated by dividing the cash outlay by the annual cash investment. So let's say that you are investing 50,000 and the cash flow you expect is 12,500 per year. And the project has a life of 7 years. All I need to understand is, in how many years will I get my 50,000 back? This is like a back of the envelope calculation. So since, according to me, I am getting this same 12,500 every year, how many years for 12,500 do I need to get back my 50,000? It's basically 4 of them. 50,000 divided by 12,500, I get 4 years. So in 4 years, I'll get my 50,000 back. This project has a life of 7 years. Next 3 years, the money I make, that 12,500 every year, that is going to be my profit. Here, I'm not concerned about time value. This is an older method. This is a method which a smaller business can use if it's more interested in just understanding whether it's, how long it's going to take for it to get its money back. That is the only point which is being considered. If the cash flows are uneven, see there we took 12,500 as the every year after year. Here, suppose it's like this, 8,000 in the first year, 7 in the second, 4 in the third, 3 in the last. And my outlay is 20,000. If you just go like this, keep adding it manually, you find that in the third year, you're getting 19. Fourth year, you're getting 22. So somewhere between the third and fourth year, you're getting back your 20,000. So basically, if you again want to go by a round figure, you're recovering your investment in 4 years. And that's all you're interested in out here. What's the positive here? It's simple to use. Risk of the project can be tackled by having a short payback period. See, the basic thing about risk is the longer payback period that you have, or the longer the project is, the greater the risk there is. With time, some risks come. So if I have a short period of time, basically there is less risk. If I have a longer period of time, there is more risk. So if I use payback to basically look at projects where I get my money back over a shorter period of time, then I am basically de-risking myself. Emphasis is on early recovery of initial investment. It gives an idea of the liquidity of the project, that is how soon I'll get my cash back. And the funds released from the project, once I get the money back, can be put to other uses. So that is the basic positive part of it. The negative is very simple. It doesn't consider the time value. That is the biggest problem with this method. Now, continuing with this, so it does not consider inflows received after the payback period. So like we said in the first example, where we said that we're getting 12,500 every year, there the project had a life of 7 years. You were getting your money back, the 50,000 that you put into it, back in the 4th year. And on that basis, you're taking a decision. But you're not considering that the project has a life of 7 years. That part is not of any interest to you. Now, if you look at this aspect, the life of the project and the amount of money that you'll get from it, you'll find that if I use NPV, I am going to get a more complete picture. For example, project A, I invest 4,000 in year 0. This is my year of investment. First year, I don't get anything. Second year, I get 4. Third year, I get 2. If I look at the traditional way payback period, then I'm getting this 4,000 back in the second year, 4,000. So the payback period is 2. I'm not even considering this 2. But if I calculate the NPV for this, I get 806. That means the total of these two, discounted at 10%, is 4,806. 6,000 in present value terms becomes 4,806. From that, if I reduce 4,000, I am left with 806. This is my net present value. Now, if I look at the second project, project B, again, I invest 4,000. I get 2,000 in the first year, 2,000 in the second year. But this particular project doesn't earn anything in the third year. It has a life of only 2 years. Now, in this particular case, if I look at payback period only, I'm getting my money back in 2 years. So if I use this as my yardstick, then in that case, it's the same for project A and for project B. But if I now try to calculate this in terms of NPV, I get a minus 530. Why is that happening? Total inflows are 4,000. When I discount it at 10%, the present value of this 4,000, 2,000 of which was received after 1 year and 2,000 of which was received after 2 years, is actually equal to only 3,470. So when I now reduce that from 4,000, I get minus 530. So if I look at it from an NPV point of view, it is better to go for project A. But if I don't have the benefit of NPV and I look at it only from the point of view of payback, then these two are equal. I have no means of knowing which one to go for. So that is something which we need to consider. Another example illustrates the problem of not taking into account the timing of cash inflows. So let's say that we take these two cases. We invest 5,000 in both of these. The cash flow pattern for the first project, C, is 3,000, 2,000, and then 2,000 again. That means a total of 7,000. Payback period is 2. NPV is 8,881. Project D, again you get 7,000, 232. But here the 2 comes in the second year. The 3 comes in the second year. In this project C, the 3,000 was received in the first year. So this project, you had an advantage. You were getting more money in the first year. And in the second project, you were getting less in the first year, more in the second. Now, in NPV terms, what does that mean? This ends up, project C ends up with a higher NPV as compared with project D. And therefore, this is preferable. But in payback period terms, it's the same. So essentially, by not considering the timing, the payback period is not as complete a method of assessment as, let's say, any of the methods that we spoke about, which considered the timing as such. You can also use a discounted payback method. But once again, the problem remains the same. In discounted payback, what would we do? We will look at each of the cash inflows. We will discount them, find out their present value, then try to calculate the payback period. So we'll have a very accurate picture now.
Yes.
And then we can also look at the actual NPV. And when we do this, we will find once again that the NPV method will give you a better picture and a more complete result. For example, in these projects P and project Q, if I go by payback period, project P appears to be preferable because it has a shorter payback period. But if I go by NPV, project Q is preferable because it has a better NPV. So actually, I'll be making more money if I go for project Q. That is something which I don't find out even after I use discounted payback. In simple payback, I got nothing. These two are the same. Both P and Q were the same. When I went for discounted payback, I was able to at least find this out. It's better to go for project Q, project P rather, because it has a shorter payback period. But when I use NPV, then I get a complete answer. I find out that it's preferable to go for project Q because it has a higher NPV. So ultimately, NPV actually helps you to get a much more complete picture about all these methods. The last method which I'm showing you is this accounting rate of return. This is again something which doesn't consider any information other than accounting information. This is also known as the return on investment method. Bad thing is it doesn't use the concept of present value at all. And it uses only accounting information as shown in the financial statements. And basically, it is the ratio of the average after-tax profit divided by the average investment to find out the return that a project has. So it has its own, let's say, value. So in this particular case, what do we have to do? We have to find the average income over a certain period of time, the life of the project, divide by the average investment, and then arrive at a return. So assume that the investment made in the project is 40,000. Assume that the investment made in the project is 40,000. Its average earnings over 5 years is 3,200. The book value of the investment depreciates every year. I'll explain this. Reaching rupees 12,000 in the 5th year. Average investment is 20,000. The rate of return will therefore be 3,200 divided by 20,000 or 16%. Now, how did I get this 20,000 here? I'll show it to you here. So you take the earnings, that is the profit before depreciation, interest and tax. It's 10,000 in year 1, 12,000 in year 2, 14 in year 3, 16 in year 4, 20,000 in year 5. You take depreciation now. Assets, as they lose value, a certain monetized amount of loss is shown in the balance sheet as the depreciation. It's an expense. So as it's losing value, I'm trying to show that this is the amount of value that the asset has gone down by. For example, if you go to a different example, let's say you have a car and it has a value of 5 lakhs in the beginning when you bought the car. The next year, the value of that car is less than 5. Why is it less than 5? Because it has depreciated. You've used the car and there is a depreciation. Now, what depreciation basically does is it puts a number to that, the sort of the wear and tear and whatever took place with the machine or the car. It gives it a number. How does it give it a number? It takes the original cost. It considers the life of the particular asset. In this case, let's say the car. And then let's say I say that a car has a life of 10 years. It has an original purchase price of 5 lakhs. Per year, it loses value by 5 lakhs divided by 10 or 50,000. So every year, I charge 50,000 as depreciation. So this 50,000 is reduced for my profit. And it's like keeping that 50,000 aside because a time will come when I will have to replace that car or a machine. So in this particular case, the depreciation was 8,000 every year. So the profit before interest and taxes, but after depreciation was 2,000 in the first year, 4,000 in the second year, 6,000 in the third year, 8,000 in the fourth year, 12,000 in the fifth year. The average was 6,400. Now, when I reduce the taxes, at the end of it all, the profit after tax that I get is 1,000 in the first year, 2,000 in the second year, 3,000 in the second year, 4,000 in the fourth year, and 6,000 in the fifth year. And this is how you get this average income of 3,200. And as far as the investment is concerned, there it's very simple. 40,000 was my investment. 8,000 was depreciation. So at the end of the year, the value of this asset was 32,000. If I average it for this year, it's 40 plus 32, 72, divided by 2, that's 36. Next year, I begin at 32. The ending value of the last year is the beginning value of the next year. I reduce the depreciation. So I end up with a value of 24,000. Add these two together, you divide by 2, you will get 28,000. You do this exercise for all 5 years. You'll have 36, 28, 20, 12, and 4. Get the average, it's 20,000. Now we know how we got our figures, 3,200 and 20,000. And we know that our return is 16%.
16%.
So this is the way we actually calculate the accounting rate of return. Basic rule here is the higher, the better. But this is something which can only be done after the project. It is not something which will actually help you today. But projects which have actually been done by you, those projects you can use this to find out what was the actual rate of return for these projects using accounting information. So that essentially brings us to the end of our presentation today on capital budgeting. And next Saturday, Pooja, it is possible that I may not be there. If I am not there, a recorded version of my lecture will be available to you. Okay, but on Sunday we'll meet.
Okay.
No problem. Sunday we'll meet. But on Saturday, what I'll do is I'll record the lecture with Neeraj sir, and then I will he'll upload that and he'll send you the link on WhatsApp, and both of you will be able to see it there. So good night then.
Okay, sir. Thank you. Good